The market's performance on a specific Monday showed a surprising rally. This occurred despite initial nervousness among investors. The Nifty 50 index closed the day at 23,408 points. This closing figure represents a significant increase of 257 points. The percentage gain for the Nifty 50 on this day was 1.11%. The Sensex, a key stock market index, demonstrated robust growth. It closed at an impressive 75,502 points. This represented a significant gain of 938 points. The performance was notably strong. This outcome sharply contrasted with the market's initial outlook. The unexpected surge indicates dynamic market conditions. The market's initial state was marked by widespread nervousness among traders. This sentiment followed 3 consecutive sessions of market decline. Such a pre-existing mood significantly influenced trading dynamics. It established a challenging backdrop for the day's trading activities. Trader apprehension often leads to cautious or volatile market behavior. Market sentiment is a critical factor influencing daily financial performance. Crude oil prices are a critical global economic indicator, influencing market stability. Early market jitters often correlate with significant movements in crude oil prices. A key factor contributing to market apprehension was crude oil prices remaining above $100 per barrel. Sustained high crude prices typically indicate underlying inflationary pressures within the economy. These elevated prices can lead to increased production costs across various industries. Ultimately, high crude oil prices signal broader economic uncertainty and potential instability. Geopolitical tensions frequently emerge in critical regions, impacting global stability. The Strait of Hormuz is a prime example, often featured in headlines due to its strategic importance. This critical shipping lane is vital for the transit of a significant portion of the world's oil supply. Any instability or disruption in the Strait of Hormuz directly impacts global oil markets. Such tensions exacerbate market anxiety, leading to potential price volatility and supply concerns. Foreign institutional investors, FIIs, are key players in global financial markets. Recently, FIIs have displayed a jittery sentiment towards the Indian market. This indicates a cautious or risk-averse approach in their investment strategies. Their investment patterns significantly influence the overall direction of the market. The Indian rupee has recently shown signs of weakening against major global currencies. This indicates that the rupee is under pressure, losing value in the foreign exchange market. A depreciating rupee means that more rupees are needed to purchase the same amount of foreign currency. This weakening can directly increase the cost of imported goods and services. Consequently, higher import costs can contribute to inflationary pressures within the economy. Despite adverse conditions, the market's closing performance showed a significant rally. This unexpected surge prompted a critical question among analysts and investors. The core inquiry was whether this rally represented a genuine market recovery. Alternatively, it could be merely a technical mirage, requiring deeper analysis. The trading session began with noticeable weakness, indicating a lack of strong buying interest. Market choppiness was also observed, reflecting high volatility and indecision among traders. These initial conditions signaled prevailing market apprehension and investor caution. This opening behavior diverged from typical patterns often seen before a significant market rally. Such divergence suggests a different market trajectory than a strong upward movement. Brent crude oil prices consistently traded above $100 a barrel. This sustained high price level significantly impacted market sentiment. The elevated prices indicated persistent concerns regarding global oil supply. Geopolitical risks were identified as a contributing factor to the high prices. These factors collectively weighed heavily on financial markets and economic outlooks. Recent attacks near Fujairah have significantly heightened market concerns regarding oil supply. These incidents directly led to the suspension of oil loadings in the affected region. The suspension of oil loadings creates immediate disruptions in the global oil supply chain. Such events pose a direct threat to the stability and reliability of oil transportation routes. The market reacts to these threats with increased volatility and uncertainty in oil prices. Ultimately, these attacks undermine global energy security by jeopardizing critical supply infrastructure. West Asia's geopolitical landscape remains characterized by persistent instability. The region has not achieved a state of calm or sustained peace. This ongoing instability is a significant factor in global affairs. It directly contributes to a pervasive sense of uncertainty. This uncertainty is acutely felt across global financial markets. The lack of resolution in West Asia impacts international economic stability. The India VIX is a crucial index that quantifies market volatility and investor fear. It serves as an indicator of the expected fluctuation in the Nifty 50 index over the next 30 days. A high VIX reading, such as 21.6 points, signals significant investor apprehension. Elevated VIX levels suggest an increased potential for large and rapid price swings in the market. Conversely, a lower VIX typically indicates a period of greater market stability and lower perceived risk. The India VIX index, a measure of market volatility, decreased by approximately 4.6% during the day. Despite this decline, the VIX reading of 21.6 still indicates a nervous market sentiment. A VIX level above 20 typically suggests heightened investor anxiety and potential market instability. This reading signals a need for caution rather than a confident trading environment. A pivotal shift in market dynamics occurred during a specific intraday period. This critical window was identified between 2:15 p.m. and 2:50 p.m. This timeframe marked the day's most significant market movement. Within this narrow window, a rapid surge in index values was observed. The concentrated movement indicates intense trading activity and price action. Such periods are crucial for traders and analysts to understand market behavior. The Nifty index experienced a significant surge during the critical afternoon trading period. It recorded an absolute tier, indicating a very rapid and strong upward movement. The index rose by over 450 points from its intraday low point. This swift and substantial increase in value was unexpected by many market participants. The rapid ascent caught numerous traders off guard, impacting their positions. A primary market driver can be short covering, especially before weekly options expiry. Short covering occurs when traders who bet against the market face potential losses. To limit these losses, these traders are compelled to buy back shares. This forced buying creates upward pressure, contributing to market surges. The approaching Tuesday marked the weekly expiry of Nifty options. This deadline creates a sense of urgency for traders. Traders with short positions must adjust their portfolios. The weekly expiry impacts trading strategies and market movements. A market decline over 3 days led traders to accumulate put options. These traders also held short futures positions, anticipating further price drops. However, a sudden market reversal created a squeeze situation for them. A squeeze compels traders to cover positions to avoid larger losses. This scenario forced swift action from the traders to mitigate risk. Market stabilization often precedes a shift in investor sentiment and trading activity. As the market begins to rise, investors holding short positions face increasing pressure. These short positions must be covered to limit potential losses. The act of covering shorts involves buying back the underlying assets. This buying pressure creates a self-reinforcing loop, fueling the rally's momentum. A market rally is an upward movement in asset prices, often indicating investor optimism. This specific rally was characterized by compulsion rather than confidence. Compulsion implies that buying was forced, not based on genuine belief in market fundamentals. This contrasts with confidence, which reflects fundamental optimism and strong market belief. Therefore, forced buying, not underlying positive sentiment, was the primary driver of this rally. Market performance is significantly influenced by the coordinated movement of heavyweight stocks. Key examples include major financial institutions like HDFC Bank and ICICI Bank. Prominent industrial giants such as Reliance Industries also play a crucial role. These large-cap stocks, including SBI, exert substantial influence on overall market trends. 4 major financial and industrial entities significantly influence market indices. These giants hold substantial weight within both the Nifty and Sensex indices. Their collective market capitalization contributes heavily to overall index performance. A synchronized upward movement among these companies is observed. This coordinated growth directly propels the broader market upwards. Their performance is a key driver for the overall direction of the stock market. The Nifty index is a benchmark for the Indian stock market, reflecting the performance of its top companies. It comprises a selection of the largest and most liquid Indian securities, representing various sectors. The movement of the Nifty index is significantly influenced by its constituent stocks. Specifically, the largest constituent stocks hold substantial weight within the index calculation. When these major stocks experience positive movement in unison, their collective impact drives the index up. This demonstrates how the performance of key companies directly dictates the overall index direction. A perceived easing of the oil panic subtly influenced market dynamics. The shift was not indicative of a crisis resolution. Instead, it reflected a reduction in the probability of worst-case scenarios. Market sentiment improved due to a decreased likelihood of extreme negative outcomes. The Strait of Hormuz is a critical global shipping lane, vital for oil transport. Despite its strategic importance, the strait was not formally declared fully open. No explicit formal agreements were reached regarding its operational status. However, markets perceived subtle indications of de-escalation in the region. These softer signals of reduced tension influenced market reactions positively. Tanker tracking systems provide real-time data on maritime vessel movements globally. These systems monitor the routes and status of oil tankers and other cargo ships. One specific signal indicated a Pakistan-bound tanker's successful transit through Hormuz. The Strait of Hormuz is a critical choke point for global oil shipments, often subject to geopolitical tensions. The successful passage suggested that transit through the strait remained possible. This observation provided crucial insights into the operational status of key shipping lanes despite prevailing tensions. Diplomatic discussions are actively underway between India and Iran. These talks focus on ensuring safe passage for Indian ships through critical waterways. The primary objective is to secure maritime routes for Indian vessels. These communications have helped to alleviate immediate concerns regarding potential blockades. The ongoing dialogue aims to prevent disruptions to shipping and trade. The International Energy Agency, IEA, monitors global energy markets and supply chains. The IEA signaled the potential for emergency oil reserve releases. These releases are a strategic measure to address market volatility. The primary goal is to mitigate severe oil supply shocks. Ultimately, such actions aim to stabilize global oil prices. Recent developments have positively impacted market sentiment. The perceived worst-case probability has been significantly reduced. The risk of a total supply freeze has diminished. This shift indicates a transition to a managed disruption, offering market relief. Stock market dynamics are influenced by various factors that dictate asset pricing and investor behavior. One such factor is the emergence of value in specific stocks. This typically occurs after a period of sustained decline in the stock's price. In this scenario, a stock experienced 3 consecutive sessions of decline. This downturn rendered the stock significantly undervalued relative to its intrinsic worth. Such conditions attract tactical buyers who capitalize on the perceived value for potential future gains. Large-cap financial stocks recently experienced significant market downturns. Similarly, large-cap auto stocks also faced considerable selling pressure. These declines made both sectors appear undervalued to investors. Bargain hunters identified these stocks as attractive investment opportunities. This perception led to a surge in fresh buying interest for these large-cap companies. A market rally was already in progress, driven by initial short covering activities. Short covering occurs when investors buy back borrowed securities to close out a short position. This buying pressure contributes to an upward movement in asset prices. Bargain hunters, seeking opportune entry points, then entered the market. Their tactical buying added further momentum to the existing rally. This combined activity created a positive feedback loop, reinforcing the upward trend. The Nifty index recently closed above the 23,400 point mark. This closing level holds significant technical importance for market analysts. It establishes a key resistance or support level for future trading. Traders will closely monitor this level, especially for the next day's expiry. Mid-cap and small-cap indices exhibited less conviction compared to headline indices. This indicates a narrow rally within the market. The rally was primarily led by heavyweight stocks. It did not reflect broad market participation. This suggests a concentrated market movement rather than widespread growth. Certain sectors exhibit heightened sensitivity to energy price fluctuations. These include oil marketing companies, directly impacted by crude oil costs, Shipping-linked industries also face pressure from fuel expenses. Import-heavy industries are vulnerable to rising energy import costs. These energy-sensitive sectors consistently remained under economic pressure. This sustained underperformance served as a subtle, yet significant warning sign for the broader market. The market often experiences broader rallies, indicating overall positive sentiment. However, specific companies can still face significant challenges despite this general upward trend. Bond and Bank's performance served as a key example of this stock-specific stress. Its results highlighted that individual vulnerabilities can persist even in a strong market. This phenomenon indicates that underlying issues can affect particular stocks disproportionately. Investors must analyze individual company fundamentals, not just broad market movements. Geopolitical volatility significantly influences global capital markets. This uncertainty leads to increased caution among investors and corporations. Major corporate decisions, such as IPO plans, are often paused or delayed. The reported pause of PhonePe's IPO highlights this prevailing market sentiment. India's wholesale price inflation, WPI, is a key macroeconomic indicator. In February, WPI rose to 2.13%, marking a one-month high. This increase signals growing inflationary pressures within the economy. The WPI surge reflects changes in the average prices of goods at the wholesale level. Crude oil prices exceeding $100 per barrel pose a significant threat to the Indian rupee's stability. Elevated oil prices increase import costs, leading to a widening current account deficit for India. A larger current account deficit typically weakens the domestic currency, making the rupee vulnerable. This situation complicates the Reserve Bank of India's decisions regarding interest rate policy. High crude oil prices have a significant impact on global industries. Industries heavily reliant on imports are particularly vulnerable to these price fluctuations. Increased crude costs directly raise the expenses for raw materials and transportation. This surge in operational costs leads to a squeeze on profit margins for these businesses. Consequently, their overall profitability and financial health are negatively affected. This economic pressure can lead to reduced investment and slower growth within these sectors. The bond market is highly sensitive to macroeconomic developments. Key macroeconomic factors include inflation rates and interest rate trajectories. Inflation directly impacts the purchasing power of future bond payments. Interest rate changes directly influence bond yields and their attractiveness. These factors collectively shape investor sentiment and bond market activity. The currency market operates with constant vigilance, continuously monitoring various economic and political factors. Key indicators such as inflation rates significantly influence currency valuations. Changes in interest rates also play a crucial role, affecting the attractiveness of a currency to investors. Geopolitical stability is another critical factor, as instability can lead to rapid currency fluctuations. These shifts directly impact the value of specific currencies, such as the Indian rupee. Market participants react to these developments, adjusting positions to mitigate risks or capitalize on opportunities. The Federal Reserve's upcoming meeting is a critical event for global financial markets. Decisions made at this meeting, particularly on interest rates, are closely watched by investors. Interest rate changes directly influence the cost of borrowing and lending worldwide. These adjustments can significantly impact international capital flows and investment strategies. Therefore, the meeting's outcomes have far-reaching implications for economic stability and growth. A recent Fed meeting drew significant global attention. Simultaneously, ongoing conflict in West Asia created geopolitical instability. This instability contributed to a volatile global oil market. These events highlight the complex interplay of global economic and geopolitical factors. U.S. stocks demonstrated resilience in market performance. This resilience was observed as oil prices retreated from their daily peaks. The decline in oil prices provided a minor boost to global risk appetite. This positive shift offered a brief respite from broader market anxieties. The market reaction indicates the interconnectedness of commodity prices and stock performance. Global investor positioning remains highly fragile. This fragility is due to a combination of significant geopolitical and economic factors. Ongoing conflicts contribute to market uncertainty and investor caution. Crude oil prices exceeding $100 per barrel add substantial economic pressure. Uncertain trajectories for interest rates further complicate investment strategies. These combined elements underscore persistent and elevated risks in the global market. A recent market rally was primarily a technical rebound rather than a fundamental re-rating. This indicates the rally's drivers were not rooted in underlying economic improvements. One key driver was expiry mechanics, related to derivatives contract settlements. Another significant factor was the dominance of heavyweight stocks in the market. These technical factors influenced market movements, creating a temporary upward trend. The rally did not reflect a positive reassessment of India's overall macroeconomic outlook. Several underlying economic risks remained active, impacting global markets. High crude oil prices contributed to market instability and increased operational costs. Geopolitical uncertainties, such as those in the Hormuz Strait, elevated market volatility. Rising inflation and a nervous rupee indicated domestic economic pressures. Cautious behavior from foreign institutional investors, FIIs, reflected investor apprehension. The future trajectory of the market is influenced by several critical factors. One key determinant is the stabilization of oil prices, impacting global economic stability. Geopolitical de-escalation also plays a crucial role in shaping market confidence and investment. The Federal Reserve's monetary policy stance significantly guides market direction and investor sentiment. Therefore, continuous vigilance and careful analysis of these factors are essential for market participants.